All right. If you've been keeping an eye on the digital asset markets today, you know exactly what we're diving into. A really sudden, sharp reversal.
Yep.
That whole U.S. government shutdown thing, 43 days, everyone was watching it, finally got resolved.
Finally.
And you'd think, okay, risk on, party time, right? Nope. Classic sell the news, a real dump.
It really was. And that pivot, it just completely broke the market structure we were looking at, earlier this week.
So what's our mission today?
Okay, so we need to unpack two really bearish data points that drove this. There's this massive derivatives cascade, like $500 million.
Okay.
And it just a complete U-turn in institutional flows,
I-
a real whipsaw. We need to set that against the backdrop of something else, though.
Which is?
The counter narrative, which is still there, actually. The long-term infrastructure adoption by TradFi, that's still accelerating.
Okay, let's get specific. The damage is clear. We couldn't hold $104,000. That seemed to trigger a huge liquidation event. What was it? $530 million in longs?
That's the number. $530 million longs liquidated.
But the thing that really, I think, gives pause, the real gut check, was the money leaving the ETFs. $278 million net outflow from the U.S. spot Bitcoin ETFs.
Exactly. That's the core question, isn't it? Is this just noise, some deleveraging, or is this something deeper? Like, are institutions genuinely losing interest here, undermining the whole long-term case?
Right. Let's dig in. So first up, the macro trigger. The shutdown's over. House voted 222-209. Trump signed the bill. 43 days of uncertainty. Gone. So why did the market tank when the good news actually hit?
Well, it's the textbook definition of an anticipation trade unwinding, isn't it?
Buy the rumor, sell the fact.
Precisely. The moment that political risk was actually resolved, that was the signal. Time to rotate. Capital moved out of, riskier digital assets.
And where did it go?
Back into traditional equities. It's fascinating, actually. That rotation helped push the Dow Jones to a new record high. So the tailwind of anticipation, it became a headwind at the resolution.
And that risk-off move had immediate technical fallout. We broke 104K, plunged right down to test support around $101,000.
Yeah.
We're hovering around $12,500 as we record this, so that's what, a 2.5% drop in 24 hours. Failing to rally on the actual news, that feels pretty bearish short term.
It does, and we can't ignore the other hangover from the shutdown for the wider market.
You mean the CPI data?
Exactly. The Bureau of Labor Statistics folks were furloughed, so the October CPI report data collection got delayed. The market hates uncertainty, and now the Fed is kind of flying blind on core inflation trends.
Which just adds another layer of risk.
Right, and probably adds to the appeal of safer traditional assets right at this moment.
Okay, let's pivot to the derivatives market then. Total liquidations hit $643 million. That number just screams leverage purge. Was it? Or just a slow bleed?
Oh, it was definitely a purge. Fast, leverage-driven, no doubt about it.
How could you be so sure?
Look at the breakdown. $530 million of that total was longs getting liquidated. Compare that to only $113 million in shorts.
Wow, nearly 5 to 1.
Exactly. That ratio tells you it was leveraged bulls. People who probably jumped in after that brief bullish inflow we saw the day before, they got caught completely offside by the macro reversal.
So the market got deleveraged in a hurry. And there's one data point that just perfectly illustrates the frothiness, doesn't it?
Oh, you mean the pulpitat liquidation?
Yeah. The single biggest liquidation wasn't Bitcoin, wasn't Ethereum. It was a $21.29 million long position on the Popicat USD meme coin pair, on Hyperliquid.
Wait, say that again? $21 million.
On Popiat. $21.29 million.
Okay, that's not just froth. That's the entire speculative bubble bath being popped right there. I mean, that level of leverage on a meme coin, even as an outlier, it just shows the kind of, frankly, insane risk appetite that was floating around.
Painful for whoever held that position, but maybe healthy for the system.
You could argue that, yeah.
Yeah.
It cleanses that excessive speculative risk.
So after this huge deleveraging event, what's the technical picture look like now?
Well, we've shifted. We were consolidating. Now it feels like a definite negative short-term trend. The market's trying to find a floor. We're testing that S1 support band, $102,400 to $103,000.
And the big one, the line in the sand.
Still $99,000 to $100,000. That's the key psychological level, the technical last line of defense. If we lose that, well, this short-term damage could turn into something much deeper.
Okay, now the big one. The institutional flows. This feels like the most significant piece today. One day we're cheering a $500 million inflow.
Right, felt like a turning point.
The next, it's gone, vanished. The idea of a steady institutional bid seems, well, invalidated pretty quickly. A total capital exodus.
That's right. The final numbers for Wednesday, November 12th show a cumulative net outflow of about $278 million from the U.S. spot Bitcoin ETFs.
From plus 524 million to negative 278 million in basically a day. That's a massive whipsaw.
It really is. And it strongly suggests that Tuesday inflow was probably an anomaly, maybe a single large buyer, maybe even an admin thing, not the start of some new wave of institutional demand. The risk-off stance is definitely back.
Okay, so the narrative emerging from dealing desks is fatigue, institutional fatigue. But hang on, Bitcoin's still up 10% year to date. That's still pretty good compared to bonds, right? Or inflation. Is fatigue just code for we found something less jumpy?
That's a really good point, and analysts are using the term disengagement more than, say, panic selling.
Okay, disengagement. What's the difference?
They're looking at relative performance. Bitcoin's 10% gain this year. It's lagging. Gold is up 21% since August. The S&P 500 is up 7% in that same time frame. The Dow just hit a record high.
So they're not dumping in fear, they're just chasing momentum elsewhere.
Exactly. They're rotating into what's working right now. They seem to be losing patience, using crypto as a source of funds to get back into traditional assets that have clear momentum. It's not necessarily a forever judgment on crypto, but it shows they're grabbing the low-hanging fruit instead of, buying the dip here.
Makes sense. What about Ethereum ETFs? There was hope that the new Treasury guidance on ETP staking might turn things around there. Any luck? Was that the magic bullet?
Sadly, no, not at all. Spot Ethereum ETF saw another net outflow on Wednesday, $107.18 million out.
So the guidance didn't move the needle.
It seems not. Suggests the skepticism about Ethereum runs deeper than just the staking yield issue. It might just be part of this broader caution about volatile assets during this rotation period.
Right. It's easy to get caught up in the day-to-day price swings and the outflows, isn't it? But we need to zoom out. Look at the counter-narrative.
The build-out continues.
Yeah, that TradFi crypto convergence hasn't stopped. If anything, the structural infrastructure build seems to be speeding up. We're seeing new commitments from really big players who don't seem fazed by the short-term chop.
And that's the fascinating duality, isn't it? Institutions are pulling trading capital out short-term, but they're simultaneously building the plumbing for future capital inflows.
Like BNY Mellon.
Exactly. Bank of New York Mellon just launched the BNY Dreyfus Stablecoin Reserves Fund, ticker BSRXX. This is a regulated government money market fund. Crucially, it's designed specifically to hold stablecoin issuer reserves.
And it's under the new Genius Act framework, right? We should probably explain that quickly.
Yeah, good idea. The Genius Act basically sets up a clear federal rulebook in the U.S. for how these stablecoin reserves have to be held. It adds that layer of trust, regulation, transparency.
The stuff TradFi absolutely needs before diving in deeper.
Precisely. This is essential financial plumbing, bringing stability right into the core of the stablecoin world. And guess who the first investor was? Anchorage Digital, the federally chartered crypto bank. That's a huge structural vote of confidence that goes way beyond daily price moves.
Okay, crossing the pond to Europe, similar things happening there. NPEX, the Dutch stock exchange.
Yep, regulated Dutch exchange NPEX is partnering with Chainlink and Dusk. They're upgrading their infrastructure significantly.
How so?
They're going to use Chainlink's CCIP, that's the cross-chain interoperability protocol, to issue, settle, and manage regulated European tokenized equities on-chain. Think of CCIP like a secure, compliant bridge. It lets NPEX move tokenized stocks between traditional systems and blockchain systems safely, staying within the rules.
That sounds like a big step for real-world asset tokenization in Europe.
It's huge, especially within a clear, compliant European framework.
And globally, institutional staking is getting more serious too. InChains Group, listed on NASDAQ.
Right, ICG. They just bought a proof-of-stake tech platform. Their goal, launch an institutional-grade staking service.
Covering the big chains.
Yeah, ETH, Avalanche, AVAX, Manta, Conflux, CFX. This directly tackles that need for professional, regulated staking services that big investors demand, especially with all the regulatory back and forth we've seen on staking yields in the U.S. and Europe.
But this corporate commitment, it's not all smooth sailing on the regulatory side, is it? There's a bit of push and pull.
Definitely a duality there, too. On the one hand, you have firms like VCI Global reporting $109.8 million unrealized gain on their digital treasury holdings.
Bullish.
But then you have the Japan Exchange Group apparently looking at tighter rules for listed companies holding crypto on their balance sheets.
So build the infrastructure, but navigate these really mixed signals globally? That explains the skittish capital flows, maybe?
I think it's a major factor, yes.
Let's quickly touch on security. Some good news, some bad news, right? And an interesting geopolitical angle emerging.
Okay, good news first. Europol. Their Operation Endgame 3.0 took down the infrastructure behind the Radamanthys info stealer.
That's significant. Why?
Because that specific malware had apparently compromised over 100,000 crypto wallets, so taking it down is a big win. It also reinforces the point that these ledgers are traceable, and law enforcement is getting better at using that.
Okay, the flip side. The bad news?
Unfortunately, old threats resurfacing. The Dark Comet RAT, that's a remote access Trojan, basically spyware is popping up again.
How's it being used now?
Disguised as fake Bitcoin wallet apps, fake trading apps. The goal is simple. Steal your login details using keylogging.
Oh, wait, so even as the big players build secure plumbing, these older, simpler threats persist as friction.
Absolutely. When firms like BNY Mellon are building regulated systems, having threats like Dark Comet out there trying to steal basic credentials just makes onboarding new institutions that much harder. Security is still paramount.
Now, connect this back to regulation and capital flows. Vienna, Austria. What's happening there? It seems to be becoming a bit of a crypto hub in the EU.
It really is. And the main reason seems to be regulatory certainty, specifically the MiCA framework, the Markets and Crypto Assets Regulation for the EU.
So clarity attracts business.
It appears so. Exchanges like Bybit are setting up their EU headquarters in Vienna. They're citing the Austrian regulator, the FMA, as being professional and practical. That kind of clear, workable regulation is like a magnet for talent and capital, especially compared to places with more ambiguous signals. Hashtag outro.
Okay, let's wrap this up. Here's the synthesis for you. The market got a necessary deleveraging, probably healthy long-term, but suffered real technical damage, which is painful right now.
Yep.
Short-term, it feels like we're dominated by that $278 million institutional outflow drama, that rotation. But underneath, that long-term infrastructure built by names like BNY Mellon and HEBX, that's still accelerating.
A real split narrative.
So the key conflict right now this week seems to be, can that $101,000 support level actually hold against this waves of institutional, let's call it, disengagement?
That really is the tiebreaker, isn't it? So for you listening, the immediate thing to watch, that next ETF flow number for November 13th.
Is the outflow real and sustained, or was it a one-off?
Exactly. Was it a true signal of retreat or just a blip? And also, keep watching that capital rotation. Does money keep flowing into traditional equities? Does that keep the pressure on that 101K support?
So the market got through the U.S. shutdown uncertainty, political risk resolved. But now the next risk phase seems defined by regulatory certainty, or the lack of it.
It's a great way to put it.
If MiCA's clarity is pulling firms to Vienna, what does that mean for places like the U.S. with its mixed signals, the big ETF outflow, or Japan potentially tightening rules? How does that impact the ability of TradFi to actually use all this new infrastructure being built by BNY Mellon and PEX in chains?
That's the real conflict, the core tension to think about. Can the regulatory environment keep pace with the infrastructure development? That's the question to mull over as you head into the next trading session.